Ladies and gentlemen, my name is Gavin Thompson, and I'm the Vice Chairman of Wood Mackenzie Asia Pacific. And it's my real pleasure today to be speaking to you, even though I'm doing this virtually. Given the recent positive news around the development of vaccines, it's my sincere hope that I'm back in Seoul for this event next year, as indeed I was in 2019. And so I'd like to talk today about upstream corporate strategies and the need for resilience in those corporate strategies. As we all know, all oil and gas companies, the immediate priority in 2020 has been to reset spending after the steep fall in oil and gas prices and the collapse in demand through this year. But the economic fallout of COVID-19 and the gathering pace of the energy transition are also rapidly changing corporate strategies through the mid to long term. And today I'd like to show you how we're seeing these diverging approaches to the long-term outlook for the upstream industry and how companies are responding to this need for resilience in different ways. We are convinced that the impact of 2020 will be to accelerate the pace of the energy transition, and we're seeing companies and governments, of course, including South Korea, announcing net zero targets. So this is the context with which I wanted to talk today. Very briefly, my agenda will be to look at how companies are responding, the different ways that they are responding. And then I wanted to look at BP in particular. And then also to look at resilience through volatility of prices. This is not just about carbon, it's also about prices. And then what we think will happen in the global M&A market as these corporate responses and these changes in strategy start to come through in terms of deals being done. So beginning with the diverging strategies of energy companies, the long-term divergence in strategies. At one end, of one extreme, I could say, you have big oil. So you have the companies, the big oil and gas companies around the world. And these are companies that will oversee the gradual retirement of the oil and gas industry. And they're going to be returning cash to shareholders through the long-term decline in oil and gas. But they're not doing this right now. And at the other extreme, what we call here big energy. So companies that are looking to evolve very dramatically through the energy transition, move away from oil gas much more quickly and towards clean energy. And if we look at the majors, and I'll talk a lot about the majors today, we can already see this happening with the oil and gas majors and a clear divergence between the European and US majors. But the same is true across the whole of the oil and gas industry, whether you're focused on oil or gas, an international company, a national oil company, a producer or explorer, upstream or downstream, staying put, not responding to the energy transition is really no longer an option. But it's still very early days, and there's huge uncertainty and risk in all of this. But I think it's important at the start of my presentation to acknowledge that this is no longer a pipe dream, it's no longer a fantasy, these are not improbable scenarios. The implications of the energy transition for oil and gas companies are huge. So let's look at what a range of companies are doing. And I begin by saying that oil and gas companies today are on the move, they're not static. The business models of the past are no longer applicable, but they are feeling their way gradually into a changing energy world. If you look at the chart here, you'll see on the left-hand side axis and the horizontal axis, we look at this in two ways. We look at how companies are decarbonizing to build a sustainable business, and we look at the pace of that decarbonization, or the velocity, as we call it here. So we put companies into a number of different areas here, and you can see that at one extreme, the companies we labeled number one, ExxonMobil and Chevron, companies which are very much remaining E&P companies, still very much believe in the oil and gas demand through the long term, but are looking to de-risk some of that. So they're looking to move out of some of their more higher carbon, higher risk projects. We have other companies, the E&P companies, we show here Lundin, Cosmos, Premier, wanting to stay in E&P, do not want to move into new energy, but are very rapidly decarbonizing. And then you get companies like Total and Shell, where we're seeing investment in new energy combined with high grading existing upstream portfolios. And then if you look at that group number 5, mostly European, being led really by BP and Eni, a much more aggressive move into energy diversification away from oil and gas. And that's what I'll talk about. So really important that there's no one size fits all solution. The European majors are pushing hard towards that investment in new energy, building sustainable businesses with rising investment in renewables, charging, energy storage. And I think you can say there's something of a green arms race underway. Companies positioning to be seen as part of the solution to climate change rather than the problem, particularly in Europe. And BP, Shell, and Total earlier this year all successively outlined ambitious plans to reach net carbon neutrality by 2050. And we've seen others in Europe do the same. But so far, the US majors have shown little inclination to follow. And Exxon, Mobil, and Chevron, as I said, strategies remaining very much focused on oil and gas and paying out dividends that flow from oil and gas. Now, if we look at how investors have viewed this, what's apparent today is that investors have been willing to pay more for the focus that the US majors have taken to continue to prioritize oil and gas development than they have for the European majors push into diversification. And the US major stock market values are trading at a premium to Wood Mackenzie valuations, whereas the Europeans are generally at a discount. We've seen some volatility in oil prices that have pushed up stock prices just recently. And this suggests that investors see diversification away from oil and gas as higher risk. And there are other factors such as the strength of the US stock market impacting this. So what is the end game? The two strategies can and will coexist for some time. Some of the Europeans may seek to demonstrate value by spinning off new energy into separate listed companies, much as utility companies did in the 2000s. But that needs critical mass. It needs coherent strategies and clear growth paths. And at some point in the next few years, either the US focus on oil and gas or the European efforts towards diversification will start to deliver better returns for shareholders. And we'll start to have an idea of which strategic choice will ultimately be the most successful. Now, I mentioned BP several times, and many of you will no doubt have seen BP's impromptu strategy update in August this year, where BP outlined a radically new strategy, a new financial framework, and a new shareholder distribution policy with detailed guidance through to 2030 on production. And make no mistake, the change that BP is proposing is profound. And so I'd like to spend some time looking at what it means, not only for BP, but also for other companies in the future. So here we are at the end of 2020. We're in a world where the first of the major oil companies is targeting production decline, so deliberately targeting at that decline. And BP has said that oil and gas output will fall by just over 1 million BOE a day, about 40% from today, within 10 years. And that is a deliberate policy. It's going to be shaped by disposals that will go well beyond their $25 billion target. But at the same time, they're going to increase investment in low carbon technology by tenfold targeting something like 50 gigawatts of developed renewables capacity along the way. Now, this is the speed of this transition has really been pretty incredible. Only 18 months ago, just over 18 months ago, Bernard Looney, the current CEO of BP, who is in place to deliver this strategy, was talking about increasing BP outlook to 3.5 million BOE a day by 2030 when he was head of Upstream. So just think how quickly that view has changed, partly because of the pace of energy transition, partly because of what we've seen in 2020. The key question here is others will likely follow. But this isn't a story of managed decline. It's not just about BP running down their upstream business from today all the way into the future. And it's not about keeping undeveloped barrels in the ground or just selling off the assets that require most investment going forward. Well, this is about complex choices, about reshaping portfolios, and doing this by balancing continued investment in upstream for long-term resilience with the best assets alongside expanding into renewables to meet their ambitions. So the bottom line is this looks very aggressive, it is aggressive, but BP has lots of options around timing and means for how they want to do this. And I think lots of oil companies will be looking very closely at exactly how BP proceeds. Now, when we talk about resilience, often we're talking about the impact of the energy transition, of companies looking to decarbonize. But we also, of course, need to look at how resilient portfolios are to prices, and prices which have been incredibly volatile, not only in 2020, but even going back to 2015 and 16. And at Wood Mackenzie, we're very keen to understand how portfolios respond to price volatility. So we've used our Lens platform here to run the 5 super majors under different oil and gas prices to assess how the upstream portfolio reacts. And you can see that it's very clear from the charts that the different company portfolios perform very differently under low, mid, and high price scenarios. So we have $30, $50, and $70 real in our scenarios. ExxonMobil is the most leveraged to higher prices. It gains the most when oil prices rise. BP is the most defensive. It falls the least under low prices. And that's largely because of BP's large domestic gas assets, which mean they lose or gain less than their peers when oil prices fluctuate. What we've also discovered, and this isn't only with the super majors, but across oil and gas companies, we've discovered that the top 10 assets in each company's portfolio play a huge role in determining valuation sensitivity. So the thematic nature of these top assets varies widely, as it does for assets in the lowest part of the portfolio. But it's clear to us that divesting the weakest assets doesn't always strengthen a portfolio, as many of these are highly price sensitive. So the top assets are really key in an oil and gas company's portfolio. And much will depend on longer term strategy and price outlooks for the owners of these assets in terms of how much they continue to keep those assets in their top 10 or top percentile, top quartile within the portfolio. Now, looking at the global M&A outlook, I've begun talking about asset divestment, so let me continue this. We think that we're looking at a period of huge activity, potentially huge activity in the M&A market. Companies are facing enormous challenges. We have a very stretched balance sheet. Capital is scarce. We've got to pivot towards energy transition, gaining pace. And at the moment, we are tracking something like 200 potential disposals in our upstream M&A deal pipeline. And those are the possible disposals that have been targeted by companies or rumored in the media. So there could be more. And these disposals are worth at least $130 billion. And believe me, there is something in that 200 potential deals for everyone. Gas, oil, producing, development opportunities, onshore, offshore, deep water, shallow water, LNG. So much is potentially up for sale. But of course, it's a buyer's market at the moment, as it has been for a number of years, but probably even more so in 2020. And we've been seeing oil deals breaking even with a long-term price of around $50 a barrel recently. So there's certainly good value at the moment if you're a bull on the oil price. But let me talk about that a little bit more. Price discovery is going to be hard. It always is in the oil and gas industry, but particularly when we have volatility. We're seeing bargain hunters on the buy side and the sellers wanting higher prices in order to dispose of assets. Now, as I've said, it's a buyer's market. Reaching agreement on price, difficult given the volatility. But if you look at the chart here, what we show is the average implied long-term oil price for deals done in 2018, 19, and 20. So this is the long-term real oil price that we at Wood Mackenzie believe is required to make our valuation of the acquisition equal to the price paid in the market. And so we are back calculating to get to what we think deals are being priced at. And the average price may look relatively stable between $50 and $60 a barrel in 2019 and in 2020. But look at the variance by region. And here I show the US, Gulf of Mexico, and Norway as examples. Average prices in the Gulf of Mexico, we think, were just under $40 a barrel used in deals, as these were mostly smaller assets requiring tieback infrastructure. But look at the high margin producing assets sold in Norway, able to attract a premium, even in a tough market, significantly higher oil prices, we think, assumed in those deals. Now, looking at corporate consolidation and the way forward, let's be honest, balance sheets are ravaged, capital is scarce, the shift to energy transition is underway, and more M&A and consolidation is needed in the sector. Merger mania took hold just in October, a series of large corporate transactions that finally started to gather pace. The Permian in the US was in the thick of the action. ConocoPhillips acquiring Concho, Pioneer bought Parsley, and we also saw some other deals in Canada and the UK. Now, in the interest of time, as I conclude my presentation, I'm not going to read you these quotes from some various US oil company CEOs. You can read those at leisure, but the message is broadly the same. Long-term growth and survival in the oil and gas industry is going to be about scale, about competitiveness, and the ability to adapt. Now, undoubtedly, many companies are not going to survive, or at least not in their current form and structure. And the successful oil and gas company of the future will look vastly different to the way most companies look in 2020. Now, ladies and gentlemen, there's a huge degree of uncertainty. And that has been the theme of my presentation. But standing still and not taking action is no longer an option. Companies and governments must adapt and embrace change and decide how they see the energy transition developing and where they want to position themselves within that. Thank you very much for your attention, and I look forward to being in Seoul again next year. Thank you.